Jai Hind to all and welcome to this video session of capital budgeting. This topic is related to unit number 2, and here in this topic we will cover the calculation of cash flow and basic concepts of capital budgeting. Now, what is capital budgeting? This is the basic question. First question, you have to understand that what is capital budgeting, and then we will go forward, then we'll moving forward towards the calculation and basic concepts. Capital budgeting is basically the process of investing. That means the analysis is done that how the investments are made by the company in their fixed asset. That means capital budgeting decisions are related to internal investments of the company. Capital budgeting is a process of analyzing investment opportunities and making long-term investment decisions. It is like acquiring of fixed asset. For example, if you want to acquire, you want to purchase plant machinery, or you want to open new office, or you want to set up new production line, new you can say research and development activities, or anything else which is a long term investment. Long term investment means investment in the fixed assets. Accept and reject type decision, that capital budgeting decision, the process, the techniques will be helpful to you to decide whether you should accept the long term proposal, investment proposal, or not. If there are so many proposals, then you can easily rank, you can analyze and give them rank that which one is the best one. That tool is very helpful for making this type of decisions. There are numerous type of investment decisions that are involved capital expenditure. It is like as I have already told you that for example, if you want to take some license, okay, license is an intangible asset, intangible fixed asset. So capital budgeting decisions are helpful. Decision tools are very helpful to make these capital expenditure. So you will get the answers of these questions after studying all the tools and techniques. Like, what are capital budgeting? What are different type of decisions which are taken under this? Is it worth it to put money or capital in this project? That means worthability. That means you will analyze that project is good or bad, whether you have to accept it or reject it. Is it worth it to use money to buy this machine? Again, it is a decision related to long-term assets, fixed asset. Is it worth it to put money in this business? Again, if you want to buy, suppose a running business, a running company, then it comes under the category of capital expenditure, and the techniques, tools will be very helpful for you. What are the features? What are the special characteristic of capital busting decisions? The special, that means what is basically the difference between capital busting decision and the normal decision. Normal decision means for the running of the business, day-to-day activities, decision related to debtors, related to inventory. These are the normal decision, day-to-day operation related decisions. But in case of capital busting decisions, these are quite different from day-to-day operations. These are the decisions which have long-term impact on the business. Even sometimes the survival of the business, long-term sustainability of the business will depend upon the good decisions taken by the company, right, for their investments. So what are special features? Huge fund requirement, obviously. When you compare capital budgeting decision with day-to-day operation, you can easily analyze that day-to-day operations need less fund requirement. That means capital requirement, capital working capital requirement will be lesser than long-term funding requirement. So huge fund, that means the total investment, if you analyze any balance sheet of the company, then you can easily see that the investment in the fixed assets are much higher than working capital of the company. So huge funds are required for the capital budgeting decision. That's why we are saying that these decisions are very sensitive for the long-term survival of the company. High degree of risk. Why we are saying that high degree of risk is involved? Because capital budgeting decisions are not short-term decisions. These decisions are long-term. You are buying a fixed asset, so obviously you will try to see that these fixed assets which you are buying have certain life, and normally the life of the fixed assets are not 1 to 2 years. These are 5 years, 6 years, or 10 years. That means The capital busting decisions are long term decisions, right? Number of years are involved. So when you say that long term decision, obviously the degree of risk will be high, because as much as time period will involve in the decision, the level of uncertainty will increase, and so the risk will also increase. Affects future competitive strength. Obviously, yes, if the company is having good fixed asset, right? Asset base is good, then it will give strength to the company, and the company become competitive. That means in case of competition, market situation, if you have good fixed asset, good production capacity, then obviously you can make future decisions well. Companies, the you can say progress or profitability of the company will increase. Difficult decision, why we are saying difficult decision? Because uncertainty is always there. Okay, for example, if you want to buy a machine, right? So you know that what is the cost of machine right now, you know that what will be the investment, but what will be the revenue which generated by the company in future, that is uncertain. So because the information on inflow and outflow is uncertain, right? You cannot accurately calculate the total cash flow generated by the machine in the future years. That's why these decisions are, you can say, very difficult to take, because the information is not, you can say, you cannot collect 100% sure information, 100% perfect information you cannot receive. That's why the decisions are taken on the estimation basis. And if you are taking decisions on the estimation basis, then there is always a chance of deviations, right? Variations will be there. Estimation of large profit, obviously, again, this is the same problem. The profitability of the company will depend upon the investment in the fixed assets, and the profit in the normal large size company or medium size company, these profit figures are very large. So these because these profits will be generated in future, the estimation, the you can say the risk of estimation or fluctuation in the estimation is always there. So it will impact, huge impact on the decision making. If you are not sure about the input information, the output will be always, you can say, it has a fluctuation, it may have a deviation. Long term impact, yes, long term assets are involved, so the impact is also long term. Affect cost structure, huge investments are required. So if you have good infrastructure with you, then obviously you can reduce production costs, so it will affect the cost structure of the product. Irreversible decision, yeah, this is very important. When, suppose, I'm just giving an example, that will be very easy for you to understand it, that how that capital busting decisions are irreversible. Suppose you are buying some raw material, okay, and your raw material is defective. Then what will you do? You'll just go to the supplier, call to the vendor, and say that this raw material which you are receiving is defective. And obviously he, if the situations are normal, if your relationship is good, and contract is good, then obviously he will exchange it, give you new raw material, or do something, give discount or something like that, right? But this situation is not applicable on the capital busting decision. Once you install a machine, once you decide a machine should be installed in your factory premises, once you install a machine, right, it is not very easy for you to reverse the decision, right? If you reverse the decision, huge losses will be there. Well, you purchase the machinery, you install the machinery, you invested all the amount related to the machine, right? And then you find out that machine is not good for you. Then what happened? Then you have to reverse it. Normal reversal is very, very difficult, because at that point of time you have to sell your new machine, right? And the market value will be reduced, obviously. And then you again search for new machine, then again you will install it, right? It will take lots of time and cost. That's why we are saying that these decisions are long term decisions and irreversible in nature. And if you reverse it, if you want to revoke your decision, then huge losses will be there. Now, what is the process of capital busting? How to take decisions under capital busting, right? So there are 6 7 steps, right? You can easily see these two are basically the presentation. The difference is only the presentation. Otherwise, the basic concept of the decision making is same. Step number one, before taking any decision for the capital vesting, then you have to identify that what are different proposals that is available, right? For example, if you want to buy a machine, then you have to search in the market that what type of different proposals are available, what different types of machine with the different cost and benefit, right? What different options are available in the market. Then step number two, collect information, data and financial information. You have to collect all the information, right? The same example, if you want to buy a machine, you have three, four options of different machines having different, you can say functioning or different configurations. Then you have to, second point is you have to collect information. You have to collect data that what will be the running cost, what will be the output, production efficiency, capacity and all that, and financial information. Then third step is decide whether the investment is good uh, business move or not, good or bad. In that situation, you have to apply different techniques, and then from the results of different techniques, you can analyze that decisions are good or bad for you. Okay, prepare necessary finances for the investment. Once you decided that out of four machine, the first one or second one is the best, and you will go for it, then you have to arrange finance for that. Okay, you want to install, you want to buy it, then actual fund is needed. Step number one, two, three is paperwork. On the paper, you collect the information and analyze the data. Step number four is execution. Okay. Step number five, implement new program or investment. Right. You collect the fund, you take this step, you buy the machines, you install it, and then monitor progress and review success of program. Obviously, after implementation, after investment, you have to monitor it, you have to check it, that what is the progress, what are the outputs, and whether outputs are according to your calculation estimations or not. This is the process for capital budgeting decisions. Now, what are the importance? Obviously, we have discussed a lot in the previous slide. I told you what are the features, and these features will give you a roadmap related to importance. Okay, why it is important? Because no company, no business can run without fixed asset. Without capital expenditure, capex, you cannot not start your business. You have to invest. Okay, if it is a manufacturing company, obviously the investments in the fixed asset will be high. But in case of service sector, your investment will be low. But whether high or low, you have to invest something. Without that, it is not possible to run a company. Okay, so what is the importance? Long term goals. Yes, if you want to survive long term, if you want to become profitable, if you want to generate wealth for the shareholder, that your capital vesting decision must be sound on the basis of good information, on the basis of good techniques, right? You have to take capital vesting decisions. Involvement of large fund amount, because the investments involved is very high, so you have to check it again and again that whether your decisions are good or bad. A bad decision taken by the company will be like that indicate in future you will be in huge losses, right? So large investment is required, so you have to be very careful before making the investments. Irreversible decision, obviously, because huge fund is required, long term decisions are that, right? Once you acquire fixed asset, it is not very easy for the company to reverse, to revoke the decisions. So the decisions are irreversible in nature. Monitoring and controlling, high level of monitoring and controlling is required because the level of investment is very high. If you are loose in monitoring, right, then your project will not be implement as per your requirement, objective may not be met. Okay, so in that situation, you have to, your monitoring system, controlling system should be very strong. Transfer of information, obviously, because such decisions are very crucial for the company, so flow of information must be very strong, right? There should be no confusion. Then difficulty in investment decision, obviously these decisions are very difficult. Reason being, long time period is involved, the uncertainty of the information, that is you are not sure about the input output information about the investments, right? Long time is required, there are so many risks, so many uncertainties which cannot, you can say, if you are very good, very experienced person, even then there may be few factors which are not, you can say, at the time of decision making you don't have sufficient information on that factor, so risk is always there. Okay, so in that situation you have to make your plan flexible. You have to ready, the mindset will be ready that there may be few variations, few changes, okay, because of the long time which is involved in the capital vesting decision. Then capital vesting decisions are related to maximization of the wealth, right? It is always why it is department, why it is very important, because capital vesting decisions are wealth for the shareholder. These are long term decisions, and wealth maximization is also long term process, so it will be creating wealth for the company. Now, for the calculation, for the analysis of capital busting decision, there are various techniques available. Okay, few techniques are based on time value of money, and few are traditional techniques and modern techniques. Okay, before applying this technique, you have to calculate cash flow, because few techniques are based on cash flows and few techniques are based on accounting profit. Okay, so first of all, you must know that what is the difference between cash flow and accounting profit, and how to calculate accounting profit and how to calculate cash flow out of it. Okay, for capital budgeting, we evaluate cash inflow and cash outflow from time value of money point of view. Okay, what I'm saying that there are few techniques which are based on time value of money, so you have to calculate cash inflow outflow and then their present values. Okay, comparison of cash flow and accounting profit. This table will show you that what is the relationship between cash flow and accounting profit and how it is calculated. Let us take an example. Suppose a company is generating revenue of rupees 1000 in particular time period, and company is incurring cash expense of rupees 500. Cash expense of rupees 500. Okay, in that situation, yes, cash expense is 500 and the depreciation is 300. You know that depreciation is a non-cash entry, but for calculation of book profit, you have to deduct depreciation on the fixed asset from the revenue. So EBIT means earning before interest and tax will be 200. How? 1000 minus cash expense 500 minus depreciation 300. So total EBIT generated by the company in that particular time period is rupees 200. Out of this 200, you have to pay tax, and tax is paid in cash. So here we assume that tax rate is 35%. So the tax will be tax will be paid on EBIT. So 35% of 200 rupee, that means 70 rupee. So tax will be rupees 70. So profit after tax will be 130. How it is calculated? EBIT minus tax. EBIT minus tax will be profit after tax, and it will be 130 rupee. Right? This is the accounting profit. 130 rupee is the accounting profit. But calculation of cash flow will be quite different, right? Because when we deduct different expenses, you can see easily here that cash expense is 500 and depreciation is 300. As I have already told you that depreciation is a non-cash entry, non-cash expenditure. So for the calculation of accounting profit, we have to deduct cash expense as well as non-cash expense. But in case of cash flow, we will deduct only cash expenditure, right? Cash expenditure to calculate cash flow. So how we calculate? Revenue is 1000. Again, same data will be taken. Less expense, cash expense will be taken 500. EBT, earning before tax. Earning before tax is cash earning. Okay, it doesn't have any non-cash expense. So depreciation is not there for the calculation of cash flow. EBT is 500. How it comes? 1000 minus 500. So rupees 500 will be EBT, earning before tax. Then 30% tax rate is there. Tax is paid. So 70 rupee tax paid. And for the purpose of tax calculation, you can easily see here that the tax is 70%. For the purpose of calculation of cash flow, we will not calculate tax on EBT, but the tax will be calculated on EBIT, earning before interest and tax, after depreciation, because depreciation is a deductible expenditure in case of tax calculation. So tax will be calculated on the basis of accounting profit, but it will be reduced from the cash flow because tax is paid in cash. Okay, so tax 70 rupees paid, and then your cash flow after tax is 430. 500 minus 70. 430 rupee will be your cash generated from the business activity. Okay, so now you can see here your PAT, profit after tax, is 130, but your cash flow is 430, right? So one, you can easily see here, this is the method of calculation. And we have a formula. Even if you're not doing, you don't want to do this long exercise, then you can apply a formula which says that cash flow after tax is equal to PAT plus non-cash expense. So here you can see it easily that PAT is 130 and non-cash expense is 300. So add 130 and 300, you will get 430. That is exactly same which is calculating in column number 4. Now, future cash flow are estimated based. Yes, because you don't know at the time of investment, you don't know that what will be the future cash flows. So there are so many factors on which future cash flows will be dependent upon. So estimated economic life of the project, yes, obviously. Cash flow, for example, if you want to install a machine, then obviously the useful life of the machine is there, you know it. So cash flow will be generated by the machine throughout the useful life of the project. Then salvage value, that is the residual value at the end of the life of the asset. It is again a cash inflow. Capacity of the project, selling price of the product, production cost, depreciation rate, taxation rate, future demand of the product. These are few factors on which your future cash flows are depend upon. But due to uncertainty in demand, production says life of the project, selling price cannot be exactly estimated. Because in the beginning, you are in the planning phase. You actually doing paperwork, right? Before buying the machine, you are doing paperwork, you are doing planning. So at the time of planning, you cannot estimate, you cannot forecast with accuracy that what will be the future demand. So there is always uncertainty in demand. So there, and demand is always linked with the production because we do production according to demand. So if there is uncertainty in demand, so there will be uncertainty in production, then sales, then life. Everything is uncertain. You have to make certain assumptions, right? You have to make certain assumptions on the basis of which you will go for the calculation of cash flow and capital budgeting decision. So always there will be a risk attached. So always because there is always a risk attached, so you have to incorporate the risk, right? Quantify the risk and incorporate the risk in the capital budgeting decisions to get accurate results. Okay, coming to depreciation, expense, income tax, and capital budgeting, as I have already told you that depreciation is a non-cash expense, but yes, it will be deducted from the profit, right, from the revenue generated by the company to calculate income tax, because for the calculation of income tax, it is a deductible expenditure. Okay, because net present value and IRR, what is this net present value IRR? These two are techniques, NPV and IRR techniques. Okay, and these two techniques are very popular, and these techniques are based on cash flow. Okay, for the purpose of cash flow, you need all the cash expenditure. Okay, depreciation expense is a non-cash expense. Depreciation does not enter NPV IRR calculation directly, but for calculation of income tax, which is paid in cash, you have to calculate depreciation, and then by using that depreciation you will calculate income tax. Okay, income tax will be reduced from the cash, and then you will calculate cash flow, right? Obviously the capital budgeting decisions analysis should incorporate depreciation expense as determined for tax reporting purpose, not for financial reporting purpose, if there is book tax difference. The reduction in taxes generated by depreciation expense is sometimes called depreciation tax shield, which we'll be using in the questions, right? Practical questions. So the benefit which you are getting in the tax due to depreciation is known as depreciation tax shield. The effect of income tax can also be incorporated into payback period, and payback period is a technique for capital budgeting, and the accounting rate of return in the straightforward manner. In the other word, any of these capital budgeting technique can be applied on pre-tax or post-tax basis. For calculation of cash flow, there are three categories, three types of cash flows. Okay, first is original or initial cash outflow, subsequent cash inflow and outflow, and terminal cash inflow and outflow. For calculation of cash flow, which is required for application of capital budgeting techniques, different type of cash flows are needed, or you can see all the cash flow generated by the project, by the capital assets, that can be classified into three categories, right? Original or initial cash outflow. Why we are saying cash outflow? Because in the initial year, the total investments are done by the company, and investments are in the form of capital outflow, cash outflow. Subsequent means after installation and the you can say when the working of the asset, working of the plant machinery has started, then class cash flow generated by the machine or by the plant will be cash inflow, right? So this cash flow is known as subsequent cash inflow. And last is terminal cash flow. Terminal cash flow will be generated by the company when the useful life, the life of the assets are over. Okay. So again, you can see here that what is initial cash outflow? Initial cash outflow is investment made to start a project. Project can be a machine, can be a plant, can be license, R&D activity, whatever it is. So in the initial investment, right, cash outflow will be in form of purchase price, installation cost, all the incidental cost, transportation, loading, uploading, engineer's fee, architect fee, okay, all the professionals which are required to purchase, to acquire the asset, to install the asset, all the expenditure will be added. Okay. Next, which is included in the original or initial cash flow, will be additional working capital requirement. For running of a project, for running of the plant, machinery, you need some working capital, right? Working capital may be in form of cash, debtor, raw material, inventory, stock. So this additional working capital, which is because of installation of new machine, will be added in the original, will be treated as original or initial cash outflow. This working capital may be released at the end of project. The project is over, working capital which is invested in the machine will be released. Now what is subsequent inflow outflow? After installation of the machine, project inflow of the cash, machine or project, inflow of the cash will start. But after some year of outflow, you can see that initially you invested the amount in the machine. Once your machine is ready for the commercial production, so inflow will be generated by sale of final product. But in normal due production, you also need some outflow. Outflow may be in form of regular repair, maybe maintenance, maybe overhauling is required, or replacement of some accessories or some spare part. So in subsequent year, inflow and outflow both are there, but the level of inflow is much higher than the outflow. Outflow will be very marginal, very nominal. Okay. Additional working capital may be required as per the project. Last is terminal cash flow. Terminal cash flow means at the end of useful life of the asset, or the life is over, you will sell the scrap of the plant or machinery and then release of working capital. These two, scrap sale of the asset and releasing of working capital, both of these cash flow will be treated as terminal cash flow generated at the end of project. Now I have a practice problem for you. This practice problem is for calculation of cash flow. How to calculate cash flow? We already know that what is the formula for calculation of cash flow? It will be PAT, profit after tax, plus depreciation, right? Depreciation can be calculated by using SLM method or WDV, straight line method, or written down value method. That which method is applicable, that will be given in your question, and you will work according to the method which is given in the question. Here I have a practice problem. The question says that a firm buys an asset costing rupees 1 lakh and expect operating profit before depreciation at the rate 20% WDV. So rate of depreciation is 20% and method is WDV. And tax rate is 30%. Tax rate is 30% of the of rupees 30,000 per annum. What is this 30,000? 30,000 is operating profit before depreciation and tax. And this operating profit will be generated for next 4 years, after which the asset would be disposed of for rupees 45,000. Find out the cash flows for different years. You have to find out different cash flows for the different years. Okay, initial cash flow, subsequent cash flow, and terminal cash flow, right? Scrap value of the asset is 45,000 and life of the asset is 4 years, right? Because the profits are generated during 4 years, so life will be taken as 4 years. Okay, now let us see the solution. See, initial cash outflow will be 1 lakh rupees. This is the cost of the asset, and it will be outflow. It will be investment. Okay, so company have to invest, and it will be outflow rupees 1 lakh. For subsequent cash flow, we have to first calculate depreciation. Okay, so how it is calculated? WDV of the machine is 1 lakh rupee for first year. Depreciation for first year is 20%. 20% means 20% of 1 lakh, and it comes 20,000 rupees. For second year, the opening WDV will be 1 lakh minus 20,000 is equal to 80,000. So 80,000 here, 80,000 this, it will be your opening WDV, right? So for second year, for calculation of depreciation, you have to calculate 20% of 80,000, which comes 16,000. 80%, 20% of 80,000 is equal to 16,000. 16,000 will be the depreciation for second year. Again, opening WDV for third year, 80,000 minus 16,000, it will be 64,000. And calculate depreciation for third year at the rate 20% means 64,000 into 20%, and the answer will be 12,800. What will be the WDV, opening WDV for fourth year? It will be closing WDV, right, of third year. That means 64,000 minus 12,800, and the answer is 51,200. This is opening WDV for the year 4. And tax and depreciation will be calculated on it at the rate 20%, and the value of depreciation for the fourth year is 10,240. Okay, this is the calculation for depreciation on the basis of WDV, right? First two columns. Okay. Now calculate PBD. PBD means profit before depreciation. Profit before depreciation, that is already given in the question here. This is 30,000. So 30,000, 30,000, 30,000, 30,000. PBD will be same for all 4 years, right? There is no change. PBT, profit before tax. Profit before tax means profit. This is profit before depreciation, and after deducting depreciation, you will get your profit before depreciation. So reduce, deduct depreciation from column number 3. Okay, PBD, PBD. So 30,000 minus 20,000, 10,000. 30,000 minus 16,000, 14,000. 30,000 minus 12,800, that is 17,200. And for the fourth year, 30,000 minus 10,240, and PBT is 19,760. Now calculate tax. The tax rate is given in the question, 35%, and this 35% is calculated on PBT, profit before tax. So 35% for the first year, for example, first year PBT is 10,000. 35% of 10,000 is 3,500. I think this tax rate is 30%. Calculation is done. Yeah, tax rate is 30%. So there is a typing error. Tax rate is 30%, and calculation is also done on the basis of 30%. So 30% of 10,000, that means 3,000. And similarly, in the same manner, you will calculate tax for each year, second year, third year, fourth year, right? So 30% of 14,000, 30% of 17,200, 30% of 19,600, 760. Okay, you will get tax for different year. Reduce this tax from PBT, you will get PAT, profit after tax. 10,000 minus 3,000, 7,000 is equal to 7,000. That is profit after tax. Okay, profit after tax. Calculate in the same manner for rest of the years. Then in the last column, we will calculate cash flow. What is the formula for cash flow? Profit after tax plus depreciation. So profit after tax in case of first year is 7,000. Depreciation is 20,000. So cash flow will be 27,000. 20 plus 7, that is 27,000. Okay, got it? Now calculate in the same manner for the rest of the year. Second year. Second year, now see here, second year, the depreciation is 14,000. PAT is 9,800. Add it and you will get the answer 25,800. This is the subsequent cash inflow which is generated after installation of the machine, right? And this will be calculated with the help of depreciation and tax, right? Now, what is terminal cash flow? Terminal cash flow means at the end of fourth year. 4 years the life of the asset. So at the end of fourth year, terminal cash flow will be calculated. The scrap value of the asset is 45,000. That is given in the question. Then profit on sale of asset. What is the book value? book value of the machine is, book value of the machine will be taken as the opening WDV for fourth year minus depreciation for fourth year. So how it will be calculated? WDV is for 51,200. 51,200. This is opening WDV minus 10,240. See here, minus 10,240, and you will get your closing WDV. So the closing WDV for the asset is 40,960. Okay, this is known as book value also. So the book value of the asset is 40,960. So the machine which is costing 40,960 in the books of accounts is sold at the rate at 45,000 rupees. So obviously there is a profit, and profit on sale of fixed asset will be 45,000 minus 40,960, that is 40 40. And if there is a profit, then obviously you have to pay income tax in cash. So tax is 30%, 30% of the profit, and 30% of 4,040, and it will be 1212. So total cash flow generated, total cash flow, how it will be calculated? The sales price means the sales of the machine, right? After selling the machine, you will receive 45,000 rupee, and you will pay tax of 1,212 rupee in cash. So net cash flow will be 43,788. Okay, so this is the final terminal cash flow. So with the help of this example, you will be easily calculate initial, subsequent, and terminal cash flow, which is the basic calculation for application of any of the technique for capital budgeting. Either if you want to apply NPV or IRR or payback period, you need cash flow, and this is the calculation for cash flow. You have to do it first, and then you have to apply capital budgeting technique. Okay. So that's all. With the help of this example, you can easily understand that how to calculate cash flow. Do practice from your textbook. And in the next video, I will tell you that how to apply different capital budgeting techniques for the evaluation of capital budgeting projects. Thank you so much.